what we're looking for is we're looking for companies with an untapped potential for growth. Oftentimes we're talking to a seller or a business owner that is 60, 65, 70, maybe even, I mean, we've talked to business owners that are, I think, as old as 85 or 88, maybe even, that are still running their business, which I hope I have enough energy and physical ability to run a business at that age if I so desire. Oftentimes, as you know, our priorities change as we age. Even though that 70-year-old might have really been excited about growing the business 10, 20, 30 years ago, you can make the argument that at the age of 70 or whatever, they're more interested in spending time with the grandkids or playing golf or reading or whatever the activity is, less stress, and really not wanting to go out there and work really hard so that you can take a business from 20 million of revenue to 40 or whatever the case may be.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Nick McLean with us. Nick is one of the founders of 4 Pillars Investors. 4 Pillars Investors is a private equity firm that purchases and operates businesses in the lower middle market. That is from 20 million in sales to 250 million in sales. Their ideal acquisition candidates are companies with untapped potential for growth. In this episode, we talk about what is private equity, how is private equity investing different from venture capital investing, investment thesis at 4 Pillars Investors, how do private equity firms determine the valuation of a business, why is it important for founders to understand the world of private equity to have it as an exit option, what type of businesses do private equity firms back, how have rising interest rates impacted activity in private equity, and so much more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called PE10X, where I help VCs start and run their own podcast. While I was running VC10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember, there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Nick, so good to have you on the VC10X podcast. How are you doing?
Doing well. Thanks for having me.
Yeah, it's a pleasure having you on. And to start things off, can we first have your story and how you started 4 Pillar Investors?
Absolutely. I'll try not to go into too much detail because I don't want to bore your audience. But I think it's a classic entrepreneur story, but with a few twists. Earlier in my career, or even all the way back to college, my expectation or desire was to run a business. The clearest path to that in my mind was to work for a big company, spend 20 or 30 years there, rise through the ranks, and hopefully become CEO or president or whatever. And that's how I structured the beginning part of my career. However, once I got to grad school, got more exposed to companies in the middle market and the lower middle market. I consider companies in the lower middle market, maybe let's call it 50 to 250, 500 employees. Nothing too large. I still didn't think of myself as an entrepreneur, but these smaller companies definitely sounded appealing. And in concert with that, I also learned more about investment banking, private equity, mergers and acquisitions in general. That was all very interesting to me. After grad school, ditched the whole Fortune 500 type of career opportunity and went into investment banking. Over the next 5 or 10 years, or however, spent it all in and around mergers and acquisitions, investment banking, private equity backed companies, venture capital, even. And it was the craziest thing. After anywhere from 6 months to a year and a half, even though I thought the job was going to be really great, after that time period, I realized that not only did I not like the job, I almost hated the job and I wanted to get out. After one or two of those, okay, maybe that's bad luck. However, after four or five, you kind of got to start looking at yourself in the mirror. And it was at that point I realized that yes, I am an entrepreneur. However, it was just a different type of entrepreneur. I always had thought of an entrepreneur being somebody that creates a better mousetrap or a killer app or a new social media platform. I mean, not back then, I didn't think of that, but you know what I mean. However, the term wasn't popularized back then, but now there's this term called entrepreneurship through acquisition, ETA, which is popular in the search fund community. That's the flavor of entrepreneurism that really resonates with me. So in 2015, when I realized that nobody was going to give me the position that I wanted or a seat at the table that I wanted, I realized I was going to have to not only build the seat, I was going to have to build the table too. That's why I launched Four Pillars Investors. We're what's called an independent sponsor. We're a private equity firm without a committed pool of capital. We raise capital on a deal-by-deal basis, which presents some challenges because we don't have the capital locked up. However, it also creates a lot of flexibility because we can be very opportunistic in the types of deals that we pursue. I have one partner. His name's Thomas. He runs two of our portfolio companies out in the Portland, Oregon area. My primary responsibilities are deal origination, deal execution. And I would say that, sure, we all wish to be more successful, and we haven't closed anywhere near the number of deals that I would have liked. However, even without the success, even without the financial rewards, I love working in private equity. I love working in M&A. And, as long as I could just barely support my family, this is what I would be doing. I know it because I love it.
Totally, totally. That's very interesting. So is it the syndicate model that you're trying to apply to private equity there?
Yeah, I mean, I think you can use that analogy. It's not quite the exact same because in a syndicate, typically you would have multiple investors. However,
Right.
that has been the case in one of our deals where we had three primary investors. However, in one of our larger deals, we had one private equity firm that provided all the acquisition capital. So it wasn't a syndicate, but it's not. There are similar concepts to that in terms of the capital raising process, how you go out to capital providers, etc.
Great. So are you just sourcing these deals and managing these deals, or are you also putting in your own money into these deals that are happening here?
All of the above. We certainly invest in any deal that or any company that we take a meaningful ownership position in. But generally speaking, where we really provide the most value is in sourcing the deals, getting the deal negotiated so we can actually have it under letter of intent, and then driving the deal towards close. The checks I write are not very big. I mean, I wish I could write bigger checks and I wouldn't have to worry about raising the money. However, they're not. And so we need to go out to folks that can, write not only not seven-figure checks, sometimes eight-figure checks. Uh, so
Right.
so for that reason, definitely where we really can add value to our capital providers is in the deals that we find, not the capital that we bring to the table.
Totally, totally. That's certainly very interesting. And since the VC10X podcast, we mostly talk to VC firms and we know how the dynamics work there. Let's try to understand that from the perspective of a private equity, although we know that VC is a part of private equity, but the other side of private equity, wherein there is M&A acquisitions that are happening, right? So there, are these firms also similar to VCs raising funds from LPs typically and having a blind pool of capital, and then in a similar fashion to VCs deploying into acquiring companies that are maybe post growth stage? How does that work?
It's it's really it really depends on the situation. That being said, I would say the typical situation is where we're dealing with an owner or an ownership group that has been working in this business for 5, 10, 20, maybe even 40 years in some circumstances. They're ready to move on to the next stage of their life, which often means retirement. When I think of VC, I think of, sexy companies that, that are going to change the world, and they're growing like crazy, and they're worth millions and millions of dollars, and maybe they don't even have any revenue, or if they do have revenue, they're not even profitable, and they're still worth hundreds of millions of dollars, or whatever the case may be. The types of companies we look at are super boring compared to that. They have had years of sure, they've had years of revenue growth as well as earnings growth, but if we're looking at a company, it might have, let's say, 25 million of revenue, 5 million of EBITDA. That company is probably going to get valued, on the low side, maybe, 4 times that 5 million of EBITDA, so 20 million. If it's in a, really hot industry, maybe as high as 8 times, so 40 million. So for a company, that's throwing off $5 million of cash flow, we're talking a range of value 20 to 40 million, which I know is far different than a lot of the companies that you're looking at, the unicorns, or I've heard a term, a soonicorn, which is, presumably about to be a $1 billion valuation or whatever. So again, it's companies that are throwing off a lot more cash. However, they're stable, they're mature. They're looking for a new ownership group to come in and hopefully revitalize the company. That's our objective, or what we look for is, or companies that want to be revitalized, want to take that next step of growth.
Totally. That's certainly very interesting. And can you give us an insight into the investment thesis you have at Four Pillars Investors?
Sure. It might sound trite, but really what we're looking for is, we're looking for companies with an untapped potential for growth. Oftentimes we're talking to a seller or a business owner that is, 60, 65, 70, maybe even, I mean, we've talked to business owners that are, I think, as old as 85 or 88, maybe even, that are still running their business, which I hope I have enough energy and physical ability to run a business at that age, if I so desire. Oftentimes, as you know, our priorities change as we age. Even though that 70-year-old might have really been excited about growing the business 10, 20, 30 years ago, you can make the argument that at the age of 70 or whatever, they're more interested in spending time with the grandkids, or playing golf, or reading, or whatever the activity is, less stress, and really not wanting to go out there and work really hard so that you can take a business from 20 million of revenue to 40, or whatever the case may be. So we see these situations where there's the lack of desire for growth. However, there's also the potential for growth, because these three levers, or however many, are not being pulled, even though they could be. Oftentimes we have a management team that is really excited about getting back into a growth phase. So that's the dynamic that we're really looking for, and why we say that our thesis, if you will, is looking for companies with an untapped potential for growth.
Totally. That's certainly very interesting. And can you give us an insight into what do these businesses typically look like? Are these mostly physical businesses setting up manufacturing plants, or how do these businesses typically look like?
Well, I will tell you that one of the most interesting parts of what I do is learning all the many different ways that people make money. I mean, there are some businesses out there that you just think, wow, that's a business and it's making that much money. That guy or gal or team is so much smarter than I am, because I never would have thought to start a business in that industry. Generally speaking, though, what you said is right. We do a lot with manufacturing, we do a lot with service businesses, we do not so much with software or tech, But again, going back to that theme of boring businesses, these are the types of businesses that you might see out in your community. These are the types of businesses where you might use a product that they produced a part for. However, you never even see that part because it's in the inner workings or whatever. So I guess if I had to summarize, what I would say is we're looking for the businesses that are in your everyday life. It's just they're not the ones that are interesting enough or visible enough for you to pop up into your mind and think, wow, that's a really cool business. I don't know. Do you understand the point I was trying to make there?
Yeah, I got it. I got it. Totally. Awesome. And while you're trying to evaluate that, what's the true worth of that business at that point, right? And there are various different ways you can do that, right? So tell us about what are some methods that you use to evaluate the true worth of a business, and how do you get to that number?
Absolutely. What I will tell you is that there's a lot of analysis required, and I have seen financial models that have 10, 12, 15 different tabs in a worksheet. I definitely see the value there. However, sometimes I'm looking at what's called a DCF, which I'm sure you're familiar with, discounted cash flow analysis, and it goes out 10 years and it gives me a net present value down to the penny. And I'm just thinking, okay, we're looking at a model that's 10 years out, and you're telling me the precision is down to one cent. I just don't buy it. Perhaps I'm the idiot. I'm willing to admit that. However, I definitely take the more entrepreneurial approach. I always develop a model for any acquisition that we're looking for. But in terms of valuation, a lot of it is just a dialogue. It's easy to understand what the general price is going to be for a business, because I mean a lot of the businesses in the size range that we're looking for, trade in a relatively tight window. Because of that, again, it comes down to building a relationship with the seller, understanding what they would like to see from a buyer, what they would like to see happen in the business post close, and then coming to terms on an agreement. It's no different than, well, it's not no different. There are some similarities to whenever you're working on a potential contract with a vendor. Of course, the vendor wants you to pay more money. You want to pay less money. There's a middle ground that's probably going to feel a little bit too high to you and a little bit too low to the vendor. But you meet in the middle, you come to an agreement, and you're off to the races or whatever. That's a lot of how I think about it, because again, I know the big private equity shops would just think Nick's the biggest idiot for talking like this, but we are not spreadsheet driven. We are people and relationship driven, and we try to find a way to work together, not because the spreadsheet says we should, but because we like the potential of the business.
Got it. Got it. I have heard this a lot in the VC respect, especially they tell it all the time that it's a people business more than a capital business, because especially in early stages is not numbers to look at. But the stage that you're coming in, there are numbers in place, right? And but how do you decide that is this business at this stage it is at this level, but going forward, do we see this business growing, and what's the scope for that, right? And depending on that, you decide that what's going to be the revenue multiple that we're going to give this company, right?
Yep. And first off, though, I will say that you mentioned revenue multiple. We're typically or almost always talking in a multiple of earnings.
Right, right,
But in terms of our, you hit on a lot of what we think about, or at least those are the questions that we ask ourselves during the diligence process. What is the growth cycle, or what is the growth strategy? Sometimes we'll
right,
hear, sometimes we'll hear business owners talk about that they have one shift running right now. They say, you know what, Nick, if you buy this business, you can start a second shift and double the revenue overnight, and profits will more than double. It's like,
right,
okay, do you have the demand to need a full second shift? Well, no. Okay, so
right,
you don't see that there's a disconnect? Like, we can't just, it's not
right,
a build
right,
it and they will come type scenario. How
right,
are we going to build the need for that additional capacity? And sometimes you
right,
hear crickets. Typically what what we're seeing is a little bit different scenario. So I'll talk about one of our portfolio companies. We had a business owner that got comfortable at a certain level of revenue. One of his customers wanted him to grow with them. However, didn't really want to add any space, didn't want to buy a new piece of equipment. He was wealthy enough for his own personal tastes and desires, and really, again, just didn't want to grow. He was comfortable. So we bought the business, get in there and try to have some frank and honest discussions with this customer. And eventually what we learned is that this customer was getting ready to walk out of the door because he wasn't willing to grow with them. So in these circumstances, we're fighting, or we're dealing with scenarios where a lack of growth is not necessarily a defensive position. A lack of growth is actually harming the company and making it more risky. So that's just an example of how we think about where to spend our time looking at the various levers to grow. Is there a customer that has asked for additional capacity that we can't fulfill right now? Is there a customer that has mentioned that the services we are providing are great, however, it would be even better if we could provide these other services? There's a lot of different examples like that, but that's what it comes down to. Is there Are there things or activities or customers that this business is not satisfying fully today, that without a huge level of investment or risk, we could satisfy those in the future?
Totally agree on that. And you mentioned how revenue is different from earnings. So, for our audience who might not be completely familiar with what's the difference between these two terms, revenue and earnings, can you share about that?
Absolutely. So revenue is top line. That's the amount of money that your customers are actually paying you. When I say earnings, it's a broad term that typically I'm using it interchangeably with EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Now, the great investors Warren Buffett and Charlie Munger do not like the use of EBITDA. However, that's what we have to go with in our industry, and that's what we use to value companies. So if you start at the top line of revenue, you'll decrease all your COGS, all your SG&A, and you'll get to operating income. Now, if you recorded depreciation in your operating income, or depreciation or interest in your operating income, you will add those back. And that's what the calculated result would be what I'm calling here EBITDA. There's a little bit more complexity than just what I said there, but generally speaking, that would be the calculation.
Totally, that's very helpful. And now let's talk about what are the typical goals of a private equity firm, right, that engages in M&A. What are these firms actually trying to achieve? What's the end goal here?
Well, I would say that private equity firms have two types of quote unquote customers. I mean, a private equity firm doesn't really have any direct customers in the conventional sense. However, they do need to perform business development activities, and those business development activities revolve around raising money, not necessarily for this fund because it's already been raised, but raising money for the next fund and the fund after that. That's one area of business development. The other area of business development is finding companies to buy. As you might have heard, there's a lot of dry powder out there for private equity. That means that prices go up. And I would say, or I think a lot of people would say, that you really make your money on the way in, meaning if you overpay, it's going to be really hard to have a successful investment. If I'm being pessimistic, or not pessimistic, I guess, if I'm being cynical, what I would say is the goal of a private equity firm is to make the founders a whole bunch of money. I certainly think that is an objective of a lot of fund managers. I mean, I'm just going to be honest with you. I mean, I see that in a lot of different, financial related careers. However, I would say that for the folks that really have that entrepreneurial spirit, it's more about building and growing something than just what your bank account is saying at the end of the day or whatever. My partner and I are pretty similar. What gets us the most excited is whenever we're in talks with a new customer to grow the business or whatever. being able to add personnel to the team and provide a stable income for that many more people, those types of things. You know, I would be remiss if I didn't say that I'm competitive. So yes, I mean, earning a good living is something, because that's, again, there's a level of competition. But in terms of really what gets me the most excited is whenever we're able to take a business from revenue of X and take it to 2X or 3X. That's what gets us so excited.
Totally. So are private equity firms buying these firms or acquiring a sizable stake and then keeping that stake with them for a long enough period? Or is the ultimate goal to actually exit the business at some point? What's the goal
Yeah,
there?
more of the latter. So most private equity funds have a 10-year life. That means that
Okay.
they would have to purchase a business and exit that business within that 10-year period. Now there are some continuation funds and whatnot, and sometimes what private equity firms will do is move one investment to the next fund. Sometimes
Right.
that work, but the general idea is that they're going to buy and sell within that 10-year period. That's definitely one reason why private equity gets a bad name, or people think it's a bad thing, is because of that short hold period. Some folks draw the conclusion that if you're only going to hold it for that short amount of period, then you're going to cut costs, you're going to reduce employees, you're going to do all these bad things to the business that's going to look good in the short term but harm the business in the long term. I would tell you, like, our approach is the exact opposite. What we're trying to do is we're trying to build a company that is the most attractive to a future buyer. We're trying to build a company that is exciting and valuable because of the growth, because of the people, and because of all the prospects. I mean, is cutting costs important? Sure. I mean, any business needs to make sure that costs are under control and whatnot. But I will tell you, I feel like we are failing if we cut employees, especially in this day and age. On the flip side, if we don't, if we could justify not having 10 employees, then that's a responsibility for the management team to go out and find the demand so that those 10 employees can be active producing members of the team. So one thing that I talk about a lot is that all private equity is not created equally, as you probably could have guessed without even knowing the industry. But that's a huge example, and what I see happening often with some of the private equity players that perhaps I don't agree with their culture or style as much, I guess.
Got it. Got it. And that's a nice perspective there. And what are the exit pathways that are open to private equity portfolio companies, right? Is that always IPO or are there other ways as well?
I would say that there are three main exit paths. One is IPO, as you mentioned. If they're large enough, then absolutely IPO path would be one desirable exit strategy. The other is to sell to simply a larger private equity firm. So typically firms will have a target check size or a target EBITDA range for their investments. If they're able to grow that investment outside of their target investment, that means that, okay, they now are going to be attractive to a bigger private equity firm. That's very common. And then the other common exit strategy is to sell to a strategic. So if you're a widget manufacturer, you get bought by private equity, you grow from 20 million of revenue to 50 or whatever. Now all of a sudden you're attractive enough to that Fortune 500 company, or maybe not Fortune 500, but a larger company, and you get scooped up because of your production capacity or your capabilities or your IP or this or that. So I mean, there are certainly other paths, but I would say those are the three most common.
Right, totally. And in a private equity firm, how is the GP incentivized? Is it the similar structure to VC funds where it's a 2% fee, 20% carry? Is that similar or is that different?
Very similar. The only distinction I would say is that we've been in a period of for private equity fundraising of a challenging period, so there has been some pressure on that fee structure. But generally speaking, the starting point for any of those discussions is that 2 and 20 model that you referenced.
Got it. That's very interesting. And for founders that are building right now, at what stage can they think that private equity will get interested or might be interested in their business, in acquiring their business?
You know, it's a very difficult question because there are some private equity groups that focus on growth equity. Growth equity is different than the type of private equity that we are. The type of private equity that we are is, we're making control investments in stable operating companies. So what I would say is, even though a company might move past VC, first I would look to growth equity, and then second, a change of control type transaction. So since most of my knowledge and experience is in the change of control transaction, I'll probably spend most of my time answering this question there. The first part of my response is, I have written an ebook or guide about how to sell your business to private equity, and one of the comments I make in there is that the sale process can be a very long time, and what I mean by that is, to some degree, you need to start thinking about your exit strategy very early on and getting your business, changing your business, improving your business years in advance of a potential sale so that it will be as attractive as possible. These are things like, maybe a topic that's not so talked about in VC is customer concentration. One of the surest ways to kill a deal is if a company has high customer concentration, which for some private equity firms, that's as low as 20%. I think 25 to 30% is more common. But I've seen companies with 70 to 80% of their revenues coming from one customer. And you'll talk to the business owner and they'll say, "Oh, well, that's no big deal. They've been here for a long time." And you know what? I'm sure they have, but I can't give you millions of dollars just on your assurance that they're going to stick around because they've been there for a long time. So getting back to your question, though, I don't think it's ever too early. I think my advice to you, or to the business owner, is to learn more about not only private equity, but about selling your business in general, because it's definitely a different thought process. It's definitely, there are definitely different criteria and whatnot that businesses that are for sale are evaluated against, as opposed to the different levers and criteria that VC looks for whenever they're weighing a potential investment.
Totally agree. Yeah, that's an insightful answer there. Will help founders and the builders analyze their business and figure out why they might be or might not be a fit. So, what are some reasons where private equity might not be a good exit option for business builders?
Yeah, I mean, I really think it's a personal preference, and it depends on certain aspects of your business. I can tell you that if you're in the construction industry, unless you go to a construction focused private equity firm, you're probably not going to get the value that you would expect for your business. I can also tell you, going back to that customer concentration, if 50% of your revenues are coming from one customer, private equity is probably not going to be the answer for you. Beyond that, it's really just a personal relationship thing. What I mean by that is, well, let me digress for a moment. A lot of folks will call me and say, Nick, like, talk to me about private equity, and tell me about this, tell me about that. And it's interesting because a common theme that I've found over countless conversations like that is the desire on the person that's talking to me to generalize about private equity, and in my mind, overgeneralize. They're saying, what does private equity think of this? And I'm just like, and I just can't answer that, because once you get to these different companies, they're all so different, and it really is so dependent on the deal. It's so dependent on the people that you are talking to in that particular deal. And so while there's a desire for folks to hear these generalizations so they can form expectations, I just got to say, sorry, we just got to take a step back, because I'm doing you a disservice if I overgeneralize. So getting back to your question, what I would say is it's all about the relationship. If you're thinking about selling to private equity, get to know private equity. There are going to be people that call you and want to talk about your business and whether or not you're ready to sell. And even if you're not, start having those conversations, because one of the measures of success in my mind is getting to a point where you're able to do business only with the people that you want to. Okay. Now, if you're a business owner and you haven't thought about exiting, you're going to get to a point where you need to exit, and you might not have the luxury of exiting to somebody that you want to. However, the business owner that is very thoughtful about this, plans years in advance, develops relationship with potential buyers, I would say that there's a good chance that they're going to find a private equity firm that they like the people there, they've gotten to know them, they like their vision for the business, and they're going to strike a deal.
Totally, totally. So from what I've made from this conversation so far is that it's a very complex industries with different types of private equity firms with different focuses and different ways of looking at deals. And for a founder or business builder, if you're looking at private equity to as an exit option, then you need to maybe understand how different private equity firms and how they would look at your business and if it's a fit or not, right? To add more context to this conversation, can you give us some examples of maybe businesses that you have, businesses that you have acquired at Four Pillars Investors, and how are they faring today?
Absolutely. So I would say that at present, our portfolio is overweight in manufacturing. However, I'm from the Kansas City, Missouri area, and you can't walk too far in Kansas City without running into a manufacturing company. Looking forward, I would say we're more industry agnostic, but right now we're overweight in manufacturing, I would say. We own one company here in the Kansas City area. We own a couple out in the Portland area that my partner runs, and then the other major company that we own is an aluminum die casting company with locations in Chicago and Ohio. In terms of the deals, how we're able to get those closed, who the capital is, every single one is different. I'm happy to walk through that with you if you want, but here's another example of why I don't like to overgeneralize, is because every single one of those deals was totally different. They each had their challenges. At some point, they each died, and then we brought them back to life, and then maybe they died again. But ultimately, we were able to get those closed. Another comment I would make is that from the outside world, everything looks great. I mean, they are healthy companies, no question. However, as you are probably aware, this isn't Facebook or Instagram where you're seeing like all these pictures of people going on vacation and think, oh my gosh, that person is so successful. I only see them going on vacation. They must be super successful and super rich. Well, no, that's just what gets posted to Facebook. Same thing for owning a business. From the outside, it can look all great, but I tell you what, there's a lot of stress in running a business. There are a lot of ups and downs. I equate it to riding a roller coaster for the first time. There's going to be ups and downs. There are going to be twists and turns. You don't know when they're coming. You don't know how high you're going to go and how low you're going to go, but you do know you're going to end up at some point. You just hope it's at a better spot than where you started, and that's kind of the approach that you got to take.
Totally. And one key difference that I'm seeing from VC here is that a VC is backing on the founder mostly. If it's super early stage, they're mostly indexing on the founder and that this is the person who's going to build it, right? And while in M&A activity in PE, you're mostly keeping the founder aside and just looking at the business, and then you have to scale it from there, right? Is that correct?
Absolutely, absolutely. And sometimes we'll want the owner to stick around.
Right.
Sometimes we maybe wouldn't do the deal if the owner did stick around.
Okay.
Sometimes sometimes we would like the owner to stick around. He doesn't want to, and so we've got to find a CEO to step in and replace it. Or maybe we have to
Right.
hire a CFO or whatever. So the team
Right.
is very important. That perhaps there is a human element that we need to underwrite, similar to VCs underwriting the founder. However, it's not always the founder in our circumstance. Sometimes it's the management team. Also, it's the idea that what, this management team isn't quite the management team that we need, and if we want to do this deal, we're going to have to find the people to augment it.
Totally. Totally. That's very interesting there. And my last main question before we close out this episode, and this one is about how have the rising interest rates impacted activity in private equity?
Oh, I think it's impacted a great deal. Largely, again, from my experience, it has been around the exits. 2023 was a historic. I mean, to my understanding, historically low number for low activity for private equity exits. A big part of the reason for that, in my mind, is because of the rising interest rate environment. However, that's certainly a blip, I would say, on the radar, not a long-term trend. Even with interest rates remaining where they are, if you look at historical periods, it's not, we're not in a historically high period of interest rates. We're just higher than where we had been, which was a historical low period. Private equity is still an alternative asset class without a lot of correlation to the public equities market. There's still demand from LPs, investors, to have the asset class of private equity be available for their investment dollars. So, I mean, there's going to be some slower periods and faster periods and whatnot, but I think that even if interest rates remain where they same, deal volume will get back to where it was, and we'll get back to a period of more normal times, if you will.
Totally. Thanks for that answer. And now let's do the rapid fire round, wherein I'll ask you 5 quick questions about the investing and acquiring activity that you're doing at Four Pillars Investors, and you have to give 5 quick answers, right?
Okay.
So the first one goes, what are the sectors and regions you invest in?
Lower 48 United States, industry agnostic with a few exceptions.
Great. What's the typical stage of investment?
Later stage, very later stage.
Okay. What's the typical check size?
5 to 20 million.
Got it. Where can maybe business builders get in touch with you in case there's a direct way?
I would say a couple of options. First, you can email me, which I hope that my email address is popping up on the screen. Also have a YouTube channel, and for those that are looking to learn more in a textual context, just wrote a book. You can visit it at fourpillarsinvestors.com/book.
Awesome. Last one, where can our listeners go and follow you?
Twitter, my handle is at Nick for FOUR Pillars, PILLARS. And of course, my YouTube channel, which is under the same handle.
Great. I'll make sure to put all those links in the show notes below. Thanks so much for making time for this, Nick. It's been an absolute pleasure having you on and learning about private equity firsthand. Thank you.
Well, I told you M&A and private equity is one of my, I love it. So anytime I have the chance to talk about it, I enjoy it. So thank you for having me.
Pleasure. Thank you.